Ladies and gentlemen, for keeping tuned, Smart24 is the channel. Remember, you can find us on GoTV at Smart24, that is channel 394, as well as on our live stream on YouTube at Smart24 TV, as well as on Facebook at Smart24 TV Official, and on Twitter at Smart24 TV, as well as Instagram Smart24_TV. So that you can keep updated on what's happening in the world of business and stay, with the pace at which businesses are being run in Uganda. Now, in another story making headlines, emerging regional digital innovators and financial technologies to showcase their products in Uganda. Now, with increasing startups in digital innovation and financial technology, stakeholders, especially East Africa, have yet again been offered an opportunity to showcase their products and craft or services and grow their clientele. The opportunity is being offered by the High People, which launched the third season of the 40 Days, 40 Financial Technologies or 40 FinTechs, with a call to digital innovators and financial technology companies, that is FinTechs, across East Africa to take part in this year's experience. It was first launched, that is the High People, in 2020, and the initiative is a 40-day event that profiles emerging FinTechs, that is financial technology companies, with unique stories, and provides a setting for the various players and stakeholders involved in the digital and financial technology to exhibit their products and services, and also share their ideas on how more people, especially those unserved and underserved by the present financial systems and the financial markets, can be brought into the fold. Now, it also offers FinTechs useful tools and an introduction to industries, emerging technologies such as Majaloop, open source software, and guidance from Level 1 project foundation material. Organizers say the skills gained from the initiative cover Level 1 project principles, instant and inclusive payment systems, that is the IIPS, inclusive financial and FinTech in general. Now, according to Mr. Innocent Kawoya, who is the Chief Executive Officer of the High People, which is the organizer, the second 40 days, 40 FinTechs ran in the months of July and August 2021, set the bar very high and prompted them to go beyond the borders of Uganda to other East African countries. As he mentions, Mr. Kawoya says that as the High People, our extensive efforts and advocacy is partly for the intention of championing digital innovation and interoperable instant and inclusive payment systems, that is the IIPS, in Africa, to a point where our innovators enjoy and achieve sound profit margins to help them keep designing and deploying affordable and inclusive financial services for the poor. It was thus pleasant for us to learn that up to 25 of our Season 2 participants not only continued to enjoy increased client engagement and better bottom lines as a direct result of participating in the 40 Days, 40 FinTechs initiative, but are also helping to generate economy-wide efficiencies by digitally connecting millions of low-income earners and consumers that are learning to transact at a fast rate. That is according to Mr. Kawoya. He also added that, but this is just the start, and we acknowledge there is a lot more to do in Season 3, that is of the 40 Days, 40 FinTechs initiative, and starting mid-2022, with optimism that the initiative will impact even more livelihoods and, of course, lives going forward. Now, the initiative, which is the High People 40-day, 40 FinTechs initiative, has quickly grown into the world's premier showcase event for the innovations that are enabling ever more people to join the digital economy space. Season 3 is expected to cover physical destinations in Uganda, Kenya, Tanzania, Burundi, and of course Rwanda. Run under the High Peoples include Everyone project that also encompasses other initiatives such as the FinTech Landscape Exhibition, Women in FinTech, Hackathon, Summit and Incubator, and Digital and Financial Inclusion Summit and Digital Impact Awards Africa. 40 days, 40 FinTechs delivers over 2 months of exhibition, dialogue, and discussion, one not seen in the sector before. It also draws the most attention yet to what is undeniably the future of digital financial services interoperability. That is what 40 FinTechs and 40 days is all about. According to the organizers, the High People, the FinTechs will get cost-free exposure aided by the generosity of Level 1 Project, an initiative of Bill and Melinda Gates Foundation's Financial Services for the Poor, FSP program, that is still of immeasurable value. It will be exciting to see what the participants have to offer, and again, various stakeholders will be on hand for more discussion and debate with this time round extra insight from the likes of banks and MNOs, and we anticipate extensive discussion on instant and inclusive payment systems, central bank digital currency, that is the CBDC, which is highly anticipated in the country, advancing convenience for users, cross-border payments, and on micro-lending products, especially those offering facilities to persons and communities that are still on the bylines of finance and trade. For example, women, the people with disabilities, PWDs, and of course other SIGs, according to Mr. Kawoya. The initiative is implemented by High People in partnership with the Crosslake Technologies, Modus Box, and Moja Loop Foundation, as well as the generous sponsor by the Gates Foundation. Then registration is on basis, so qualifying for FinTech stakeholders operating in Uganda, Kenya, Tanzania, Rwanda, and other participants of the continent are encouraged to book their slots before June 11th, 2022 by visiting the High People website right there. That is a story coming in from the High People who are organizing an initiative known as 40 Days, 40 FinTechs, which is 40 financial technologies companies, where they give you an opportunity to give the public what you're doing in terms of financial technology, in terms of improving the payment systems of Uganda, paying across the globe, paying across borders, payments across different cultures, and helping people actually access financial services at their fingertips using technology. So if you are a FinTech or FinTech enthusiast, lawyer, or someone who is into financial technologies, this is an opportunity for you to actually participate and get to know a little bit more about FinTech. And you can as well get your organization put up there so people can know what you're doing. So this event will be happening for over 2 months, and you have to register on the High People website for you to actually engage yourself in this. Moving on to our next story, we have the 2022-2023 budget on its way, and we are looking at what is at stake in this budget in terms of financial markets, but as well as in terms of other markets as well. What is at stake in the 2022-2023 budget? Now, Uganda's economic growth has slumped from slightly more than 4% to 3%, with agricultural sector which has always been the safety net, looking to decline for the very first time in the last 2 or so many years. Now, the 2022-2023 budget comes at a time when the country's economy is still trying to find its footing after nearly 2 years of lockdown aimed at curbing the spread of the COVID-19 pandemic. While with inflation threatening to break the 5% ceiling, the risk of rising high prices of essential commodities, including fuel, will be ushering in the 45 plus trillion budget in an economic environment that by some indications will suffer a revenue deficit. The total resources envelope, that is the total resource envelope, the national budget for the financial year 2022-2023 is projected to increase almost by 6%, which is an additional 2.4 trillion. And this is from the 44.7 trillion Uganda shillings in the financial year 2021-2022 to 47.2 trillion in the financial year 2022-2023. According to the revenue performance for the last 3 quarters, that is July 2021 to March 2022, the Uganda Revenue Authority had a target of collecting slightly more than 16.5 trillion Uganda shillings, representing 73% of the annual revenue collection target of slightly more than 22.3 trillion. But instead, the taxman collected only 15.4 trillion, representing 69% of the annual target. Even though it was a significant growth in revenue registered over the last 3 quarters, compared to the same period in the financial year 2020-2021, the cumulative collection for the last 3 quarters of the financial year was short of the target, slightly more than 1 trillion Uganda shillings. Further, the national budget will unfold at a time when the country's economic growth has slumped from slightly more than 4% to 3%. With the agriculture sector, which has been with the safety net looking to decline for the first time in the last 2 or more or so years. Now, for the economy, so the economy cannot generate enough revenue as interest payments finally exceeded government's spending on key economic sectors such as agriculture, health, and education. The large public debt stock constrains government's ability and effectiveness to finance the implementation and management of the policy initiatives as contained in the national budget. The Monetary Policy Bank of Uganda report February 2022 revealed that the public debt increased from 69.7 trillion in June 2021 to 73.6 trillion in December 2021, indicating a 5.6% increase in the national debt. That is a debt that the country, owes in terms of, what it has borrowed. And you can see from a budget we had of 47.7 trillion to a debt compared to the debt which is now 73.6 trillion. That is almost double our budget, which is a very worrying situation. According to Uganda Debt Network, there is, however, a risk of public debt reaching unsustainable levels in the future, since the rising debt rate is high and higher than the rate of increment in GDP levels, and that is bad news for the national budget. So what is at stake in this national budget? We have seen the debt is quite high, and of course we are seeing that our GDP is not changing. GDP in simple terms could be the gross domestic product, which is how productive our country is. wherever you hear those percentages of GDP, 3.4, 2.4, we are talking about how productive, how much do we produce as Uganda, how much do we make of our own as Uganda. And so compared to what we make on our own, the GDP, our debt rate is much higher. The rate at which we are borrowing is higher than the rate at which we are being productive. And that is a worrying situation. So what is at stake? And what should we look out for as financial market analysts and enthusiasts? Dr. Adam Mugume, who is the Executive Director of Research at the Bank of Uganda, noted that financial year 2022-2023 budget should be uploaded because it focuses on industrialization for the inclusive growth while building growth in infrastructure development, and started several years ago. Dr. Mugume also believes that the 2022-2023 budget puts emphasis on fiscal consolidation, with fiscal deficit as a percentage of GDP projected to decline from about 5.1% compared to 7.5% in the financial year 2021-2022 and 9.1% in the financial year 2019-2020. In Dr. Mugume's analysis, Dr. Mugume, who is the Director of Research at Bank of Uganda, fiscal, that is revenue consolidation, is necessary to contain public debt at sustainable levels. However, the budget will have to negotiate several risks in the year. According to Dr. Mugume, the budget is premised on the GDP growth of 6% in an environment characterized by elevated uncertainty, largely stemming from the global economy shocks. In his analysis, he identified three known unknowns that the economy and the national budget will have to endure. First will be the unknown duration of the Ukrainian war and related sanctions, which have triggered a sharp increase in commodity prices. That is one unknown, according to Dr. Mugume. The second unknown is the evolution of the pandemic and whether another aggressive virus will emerge. That is the third unknown. The second unknown. The third unknown, he says, is the extent of tightening global financial conditions that is partly causing the shilling to weaken, as he said. So those are the three unknowns according to Dr. Mugume. The Russian and Ukrainian war, we don't know. Another pandemic coming up, we don't know. And then the extent of tightening global financial conditions, that is also causing the shillings to weaken, we also don't know. He however said that the inflation developments that are emerging due to a combination of those factors we have listed above suggests that the economic growth in the financial year 2022-2023 could soften, meaning that a GDP growth of 6% may not be achieved. He continued, this has implication on the budget. Fiscal or revenue deficit and public debt could be much higher as interest payments on both domestic and external debt increase. Additionally, a lower growth also means revenue shortfall, which would require more debt if expenditure is to remain at a 48.1 trillion. A budget of 48.1 trillion will need to be funded through a combination of borrowing revenue and revenue mobilization. This is a complex situation when inflationary pressures are broadcasting, requiring monetary policy tightening, and the rising prices ideally require intervention to ensure that vulnerable households are protected. But with a tight budget and the need to safeguard debt sustainability, this is delicate balancing, even when the situation could be temporary. As for economist and policy analyst, Mr. Muhumuza Fred, the problem is that is beyond the budget in many ways, is the question of constrained economic activities, which will certainly take a toll on revenue mobilization, that is mobilization of funds and efforts to get these funds, and consequently this will impact the budget. For example, he said the tax on fuel that I use is not based on value. So whether the pump price per litre increases, as is the case, the government will still be collecting the same amount per litre, that is 200 shillings. But if I consume less litres because I cannot afford it, then the tax revenue will go down. And that is a bigger worry because of its implication on the budget. So as you can see, we are in a very complex situation there. Government needs the money, the revenue to finance the budget, but as well, the prices are very high. So people are abstaining from fuel, people are staying away from all these commodities, and the more they stay away from all these commodities, the less government revenue will be collected. So we are looking at how this will be financed. Will it be through borrowing again, as we have in the past, or we can find options? Now, in his presentation at the BDO Signum organized breakfast meeting last week, Dr. Muhumuza was of the view that government's role in domestic market, where it is currently refinancing 8 trillion Uganda shillings, is not helping the economy because there is no evidence that the domestic debt incurred through the paying or through the government papers in form of treasury bills and bonds is returning dividends, save for crowding out private sector, which essentially undermines the foundation of economic progress that government is preaching. The other problem with the debt, especially if it doesn't serve its purpose, is that it undermines production. This results in scarcity of goods and services, triggering inflation. Worse still, given the scarcity, people resort to importing because the public debt didn't achieve its purpose, which is investing in productive areas in the economy or in sectors whose returns on investment is pretty much decent and guaranteed. So that's the problem. We still borrow money and still don't invest it much here in Uganda. And that creates a problem as people now seek to actually buy goods or import goods from abroad. And this is using other currencies like the US dollar, which weakens our shillings. And still, we remain in the problem, really. Now, and should the importing country get hit by inflation, if we are importing a lot of goods from abroad and then we are hit by inflation, then rest assured that those shocks will find their way to your door step, that is the economy. This is the problem we are facing now. We cannot substitute, even in short term, the things that we are importing. As a result, the economy takes care of itself through high prices for the scarce goods and services. So inflation will always try to solve distortion within the economy, although oftentimes in an ugly way. That was according to Dr. Muhumuza. And speaking during the high-level conference titled Building Stronger Partnerships for Sustainable Financing in Uganda at Kampala last week, Ms. Mokami Kariuki, who is World Bank's country manager, said that increase in public debt puts a lot of pressure on government in form of servicing debt and interest payments, which affects the resources available for the national budget. She said that the rise in public debt leaves government with limited fiscal space. Given that the government needs revenue to operate, Mr. John Jet Tugume, a tax expert, argues that taxpayers should brace themselves for revenue enforcement because it is only through that measure that some revenue can be squeezed out of the lulling economy. This time, the budget has tried to keep away from keep increasing taxes on many commodities because of the challenging prevailing economic situations. This makes sense, but remember, it's a huge budget with high expectation. So government is looking for enhanced enforcement of existing laws to collect more revenue needed to finance the budget. That's according to Mr. Tusabe during the BDO Signum budget analysis meeting last week. When contacted, the Economic Policy Research Center research fellow Mr. Koti Paul Lakuma noted that although there is need to suppress the effects of COVID-19 induced shocks through spending, it should have been done wisely, lest another Pandora box is flung open. He said, indeed, we are in a state where we need increased public spending to cover and contain the effects of the COVID-19 pandemic, but common sense suggests that this would be inflationary and may hurt household spending. However, we should remember the inflationary pressure we are experiencing is largely supply-driven and not demand-driven. Therefore, easing interest rates will only address the short-term inflationary pressures. He continued that this suggests that the best solution to this problem is to deal with the supply shocks by creating a stock of petroleum products and increasing the domestic production of cooking oil and soap, of course, right there. So that's a story we will be keeping you updated on, and we will be talking about the national budget and what it has in store for us. We are seeing that it's steadily increasing from over 47.7 trillion to now the projected 48.1 trillion. And we are saying, where is this money going to come from, given the tough economic times we are living in? We are going to go into a short break, and we shall return shortly. Don't go anywhere.